7 is often seen as a lucky number, but not this time. The consumer price index is up 7% in December from December 2020. That's the highest rate of annual increase in inflation in almost 40 years, since June of 1982. Even core prices, if you exclude volatile items like food and energy, even then, still the fastest pace of increase in almost 31 years. This increase in prices very broad-based. And what today's report tells us, I think, just validates what millions of households already knew, and that is inflation's a problem. Prices are going up, and they're going up pervasively, and they're going up at a rate that outpaces growth in household income in many cases. Food prices are up over 6%. Energy prices up over 29%, and shelter costs, which tend to lag, already up over 4% year over year. And I think that's the one to watch in the months ahead. There are two major contributors to the inflation that we're seeing right now. The biggest and most significant is the supply chain disruptions. And until the supply chain returns to something what we would call normal on a sustained basis, we're likely to be contending with these outsized price increases. On the demand side, we've also seen a rapid snapback in demand after the economy was initially largely shuttered in the early stages of the pandemic. So while consumers have money to spend, that imbalance between supply and demand has contributed to the higher prices on everything from the cost of homes and cars to what you see at the grocery store or anywhere else for that matter. The Federal Reserve had what I would describe as a very laissez-faire attitude toward inflation in 2021. And only at the end of the year did they really get the memo that this is a problem. And as a result, we've seen them pivot very quickly in terms of how they view it and how they plan to address it. Specifically, we will see the Fed start to raise short-term interest rates. They're likely to start that as soon as March. And around that time or shortly thereafter, they will not only stop buying bonds and adding to their portfolio, they will start letting the size of that portfolio shrink, letting that run off. That has the effect of pulling liquidity out of the system. So even though that happens behind the scenes, I think that's arguably the more significant item. Both of those will slow the demand side of the economy over time, but they're not going to address nor fix the issues with the supply chain.